Welcome, class, to a podcast or video about fair value and present value and how they apply to intermediate accounting. The idea of fair value is that is what something is worth. An asset typically, but it also applies to liabilities. And the idea is, at what price would it exchange between a willing buyer and a willing seller? So what we're trying to do is come up with an estimate of what it would be if there was an exchange, assuming that there hasn't been an exchange yet. If there is an exchange, then obviously we do not need to worry about estimating fair value. But often the assets we still own, but we have to estimate their fair value. And present value of future cash flows is the default in terms of what the fair value of any asset is. And so that's why these two terms are related. They're not the same thing, but present value is one way to calculate fair value of our assets and liabilities. So with more and more things on the balance sheet being listed at fair value rather than their original cost, there needed to be some guidance for how to determine fair value. And so FASB gave us some guidance in the form of a fair value hierarchy, which is included in the codification in exactly this form. So these are the exact terms, and in fact you'll find the same terminology in the footnote to almost every annual report published, because they cut and pasted this terminology to make sure they got all the wording correctly in describing the three levels. So the first level is when prices are easily found. There's a well-established market. They're trading on, say, on the New York Stock Exchange. You just look up the price. You know how much it is per share or per bond or whatever the asset is that's being exchanged. And you get that amount, multiply by the number of shares or bonds you have, and you know what your asset or liability is going to be based on easily observable inputs, and you and anybody else that looks at it should come to the same conclusion. So that's where you go first. You always start with the input level 1. Then you go to 2. If that's not available, if there's no directly observable price, there's not a well-established market for these assets or liabilities, then you move to level 2. This is where you can indirectly observe. You can see a price of something that is similar to what the asset or liability that you have on your balance sheet. You don't have exactly the same thing on your balance sheet as what other people have, but it's close. Or there are inputs to calculate the value that you can observe, like interest rates or other things that are easily determined from looking at other companies or market rates in, say, a Wall Street Journal or something like that. So indirectly, you are seeing the price. So you have some things that can be verified from an external source to be able to determine your price. So these are assets and liabilities that are traded in, say, small markets or with few buyers and sellers, or sometimes what we call private markets, where they negotiate the prices individually rather than there being this quote that you can find on the internet. The last one, and the one that companies generally don't want to admit to having, is level 3. This means that there's no external reference points outside the company. The inputs are unobservable, meaning we made certain assumptions as a company. we use inputs that we determine, not based on some outside measuring stick, but based on our internal assumptions, internal thought process. It still has to be rigorously tested, meaning we don't just wing it, but it means that it's based on assumptions we made and not based on marketplace somewhere else. An auditor then would have to be able to recreate based on our assumptions and then make a judgment as to whether those assumptions were reasonable to be able to determine if we had done it correctly. That's only if you can't do level 1 or 2. So you move up this pyramid, if you will, as you find that you don't have level 1 or level 2 inputs, you can then fall to level 3. That is the, you might say, worst case scenario. So we're using fair value on the balance sheet, as we mentioned, more all the time. In fact, at this point on your balance sheet, all debt and equity securities, except some very small exceptions, debt securities held to maturity. Those are ones you're going to hold all the way till the end of the bond life, which means you don't care and are not affected by changes in value. So those can be left on the balance sheet at the original cost. And equity method investments, which is when you buy stock in a company that is sufficient enough to exert significant influence. And then you record the changes in value based on the income of that company, not based on fluctuations in price. Both of those two exceptions are things that you're going to hold for a very long time, asset or liability wise. So that's anything shorter than that is going to be recorded, be on the balance sheet at fair value and adjusted every time that fair value changes. Whenever we have an asset that is determined to be impaired, the impairment adjustment is to make the asset at fair value. So there's fair value again, anything that has been impaired. Companies can choose to have all monetary assets. That means receivables and payables, loans receivables, notes receivable, accounts payable, accounts receivable, all of those can be listed on the balance sheet at fair value. But if you do it for some, you have to do it for all. That is the choice under GAAP. So you can't pick and choose. It's got to be all assets and all liabilities. So the fluctuations kind of offset each other. Fair value is an estimated value. Many people argue it's more relevant than original cost, but obviously less verifiable, meaning it has more subjective. It has more of an element of judgment. There is an estimate involved in that. And as we mentioned earlier, present value of estimated future cash flow is the fair value of many assets and liabilities, especially if you fall to a level 3 and you don't have market forces determining the prices or the values of your assets or liabilities. So then you fall to present value often. So how does present value work? It's essentially a mathematical formula used to subtract out interest out of future payments to make them worth today, show what they're worth today after the interest is taken out. So that means the higher the interest rate, the lower the present value. So if I ask you that $1,000 5 years from now, what is it worth today? Well, it will depend on the interest rate. The interest rate, if it were 10%, it would be worth less today than if the interest rate were 5%. So when we use present value calculations, we can either do it with a single sum, that means a one-time payment, or an annuity, that's equal payments each year, or even both together and just add them together. But you can have either or a combination. Future value, just briefly mentioned, is for saving money and seldom has a application in accounting. So we're seldom, if ever, calculating the future value of something. It's almost always present value. And then the last tool in our arsenal is net present value. That's when what we use when payments are not equal, meaning the amount received or paid is different each year or every month. Then we use net present value to be able to determine its fair value. So what points do we use present value? We can use in Excel. The idea of PMT is the formula that will calculate a payment on a loan. You can calculate the value of bonds or the value of loans if they were to be sold, because loans get sold and bought all the time, as do bonds. So what value would somebody pay for a bond or a loan? They would pay the present value of the future cash flows, as we mentioned earlier. We also apply that same idea to our assets when we're checking for impairment. So an asset is going to have a future cash flows, sometimes based on being able to rent out that asset, but also it could happen because there are savings because you have that asset or you have that license or patent. That means you don't have to pay somebody else for that idea. And an estimate of those future cash flows would be used to calculate the fair value based on the present value of those future cash flows. And of course, you're going to apply it with goodwill and some other intangibles, which are almost always going to be tier 3 inputs, assumptions you have to make internally in your company.